how to turn $2,000 into $5 billion. Now, the likelihood that the average retirement saver can replicate these types of returns is highly unlikely. However, if you study how billionaires move, you can learn a thing or two about tax-free wealth and tax strategy. So in today's video, we're going to specifically look at the self-directed IRA. Let's get it. What's going on, everybody? Brian Rivera, CPA, and on this channel, I typically talk about personal finance, entrepreneurship, and investing. So if this is your first time around here, don't forget to hit that subscribe button. So raise your hand if you heard the name Peter Thiel. Maybe, maybe not. If you haven't, it's all good. But you've probably heard of this company called PayPal. So many people may not know, a long time ago before the year 2000, Peter Thiel was one of the early founders of PayPal, along with your boy, Elon Musk. So PayPal is a leader in the online payment space, payment processing. So if you're not a fan of PayPal, you don't use it, you probably use Venmo. I mean, they've got their hand in absolutely everything. Why is PayPal important to this story? So back in 1999, Peter used his Roth IRA to purchase 1.7 million shares of PayPal 3 years prior to PayPal listing as a public company. So it is reported at that time, the value of these shares was exactly $1,700. Now, once the company listed, obviously the stock price has skyrocketed. Fast forward to 2019, it is reported that the value of that purchase or those shares, those 1.7 million shares are now worth $5 billion. Now, what's even more interesting about this situation is that I believe Peter is 53 as of the recording of this video, and when he turns 59 and a half, he will be able to withdraw all the money out of his Roth IRA, no limitations, not one single cent will be subject to tax because this was all a tax deferred and tax-free transaction, which is one of the huge benefits of a Roth IRA. So you might be asking yourself, I didn't know that I was allowed to hold pre-IPO companies inside of my retirement account. Well, that's partially correct. So most people have regular IRAs, which allow for investment in things like stocks, bonds, mutual funds, other assets, ETFs, things like that, because these are housed at traditional brokers. So looking at the umbrella of the IRA account, so there's going to be two types. So there's going to be a traditional IRA and there's going to be a Roth IRA. Both have the same contribution limits. However, there are some income limitations on who can and cannot contribute. Now, the difference between the two is going to be around how the money is taxed. So with a traditional IRA, you're typically contributing with pre-tax funds. So what that means is you are not paying tax on the money that is going in. And then when you retire, you can pull that money out at retirement age. However, when you pull it out, it will be subject to your ordinary income tax bracket. Now, if you compare that to the Roth IRA, well, that is being funded with after-tax dollars, meaning you have already paid tax on the money before it goes in. And then when you hit the retirement age, you can pull that money out because you've already paid tax on it. You get the tax-free growth. And when you pull it out at retirement age, you pay zero in income tax. Now, not to confuse you, a self-directed IRA is a retirement account that can both be traditional and Roth. Now, the self-directed IRA allows or has the same contribution limits as the regular IRA, both $6,000 for you and $6,000 for your spouse. A lot of the same regulation around who can contribute. Now, if you're somebody who wants to supercharge your retirement, you can leverage something called the solo 401k, and this is going to be for individuals who are self-employed. In this situation, you can get above and beyond the $6,000 contribution limit, where you can contribute up to $58,000 into that solo 401k. Let's go ahead and compare and contrast the difference between the regular IRA and the self-directed IRA. In terms of getting money in there, like I said earlier, you've got the traditional option and you've got the Roth option. Now, where the difference is going to be or come into play is going to be in three key areas, and that's going to be diversification, specialization, and returns. The self-directed IRA allows for diversification in a variety of different assets. So if you have a self-directed IRA, you can invest in alternative asset classes such as cryptocurrency, real estate, stocks, bonds, private equity, startups. It's exactly what our friend Peter did in the example we talked about earlier. Now, specialization. When you're looking to set up a self-directed IRA, you need a trustee or custodian that specializes in less typical assets. And the reason behind that is a lot of times, let's just say you're investing in a startup company, there's not a secondary market for you to sell that position. You actually have to go out and find somebody to buy your shares. So these are a lot more illiquid type investments. Now, the other difference with the self-directed IRA is that you can potentially get higher returns. However, you are taking on additional risk. All right, so now that we've talked about the differences between the two types of IRA accounts, let's go ahead and explore maybe some of the advantages if you decided to open up your own self-directed IRA. So those two main reasons are going to be what I mentioned earlier, is that you want to take on additional diversification and you want to increase your risk. So certain asset classes, such as startups, IPOs, cryptocurrency, real estate, could yield you greater returns than what you may do in a traditional regular IRA account. The other advantage, flexibility, right? So you're gonna get greater flexibility in the type of investments that you own. If you go to your historical IRA account, you cannot buy crypto, you can't hold Bitcoin, you can't hold things like that. So if you have a self-directed IRA, you could stash away your crypto using one of these type accounts. So, and lastly, probably the most underrated advantage of the self-directed IRA is that you now have the ability to invest in things that you're passionate about, things that you have experience in, things that you have knowledge in. That's exactly what our friend Peter did. He was passionate about his startup company. He put some money in it, company blew up, and now he's a billionaire. Now, I know we've talked about a lot of great things surrounding the self-directed IRA. However, I do want to highlight some of the risks associated with using this type of investment vehicle, especially for your retirement. So if you do not follow the rules for the self-directed IRA established by the IRS, those tax-free gains go bye-bye and you can be subject to both penalties and interest. So an example of breaking the rules is there's something called the no self-dealing rule. So an example of this is neglecting the no self-dealing rule, which prohibits things like selling property to your IRA, borrowing money from your IRA, or dealing with related parties. So let's just say I invested in a rental property using my self-directed IRA, run into a situation where one of my tenants breaks a toilet, causes a slight flood. I call my plumber in, he comes and takes a look at it, quotes me an outrageous price, or I decide, hey, I can do this on my own. I know how to change a toilet. So I decide to change the toilet myself versus furnishing services from a third party. So if I did this, I actually just broke a rule in which the IRS prohibits providing services to your IRA. Now, should the IRS find out about this type of transaction, then they would reclassify all of this as a distribution, which is also subject to penalties. One other thing to note is that if you own a rental property in your self-directed IRA, do not ever spend the night in that property. Now, I'm not the expert on every single detail of what you can and cannot do in the self-directed IRA. Thankfully, the IRS has some guidance that is published out there. So what I'm gonna do is I'm gonna drop a link below so that way you can take a look at some of the transactions that you cannot perform inside of your self-directed IRA. Really, the point I'm trying to make is that should you decide to use this type of tax strategy, that you understand the rule set. So some of the other risks that you may take when using the self-directed IRA is due diligence. Any investment you decide to make, you must do all the research prior to deploying your capital. The custodian or the trustee that you have your account with cannot provide you investment advice. Should this investment be successful, it's all on you. Should it go to zero, it's also all on you. So it's extremely important that you have refined your ability to perform due diligence. Fees. So you're gonna wanna check with your custodian on fees, and I've seen a variety of different structures. Typically it's based on asset or asset class, and I've seen it somewhere in the neighborhood of $250 all the way up to $2,000. So just before you open up your account, you wanna make sure you understand any fees that are gonna be associated with this self-directed IRA. Lack of liquidity. So if you run into a situation where you need some extra cash and you gotta you basically need the funds, it's going to be tough because you're going to have to go out and find a buyer. When investing in alternative investments, specifically the ones that are illiquid, you want to make sure that you won't need that capital because it may be tough for you to liquidate it. To sum everything up, a regular IRA might be enough. For the average investor, the regular IRA can provide more than enough diversity for your retirement savings. You have multiple options. You can even trade options inside of your IRA. So for most, this might be enough. They are quick and easy to open, and they're not subject to all these different IRS rules that the self-directed IRAs have. So again, it might be easier for you to just use this type of account. You also avoid all the additional work of having to find a custodian and someone who will allow you to buy these alternative assets. So now that you've got all this newfound knowledge on tax-free wealth, tax-free savings, it's time for you to execute. So if you feel that the self-directed IRA is the way you need to go and that you can make a killing through diversifying in alternative investments, then by all means, get out there and crush it. And if you feel like the stock market is home base and that is probably where your comfort zone lies, then maybe you don't need it. You just, regular IRA will work just fine. Alright family, so if you found value in today's video and you're ready to become the next tax-free billionaire, don't forget to smash that like button. So also, if you want to explore different strategies to build your tax-free wealth, how to leverage the tax code, how to leverage tax deductions, I've decided to dump my 15-year brain into a strategy course to where entrepreneurs, day traders, self-employed individuals can get themselves up to speed on how to leverage the tax code. So if that's something that interests you, I'm dropping a link into this video description to where you can jump on the pre-launch list and you'll be notified once the course is ready. Have a good one.